that bubbly because the market just handed in its best year since 2013. All 11 S&P sectors finishing the year in the green. And it wasn't just here in the U.S. Nearly every major global market and asset classes saw positive returns in 2019. So the big question now, what can you expect for your money as we head into the new year? It's time to break out your 2020 playbook. Guy Adami, what do you got for us?
Well, first of all, Courtney, I mean, this is, in all the years we've been doing the show, this is the first time you're hosting. So on behalf of all of us, right, I wish... Amazing to have you.
No,
it's a real clap.
Thank you. New kid on the block here.
No, it's fantastic to have you. In terms of what's going to work next year, listen, I've been wrong now for months in terms of market direction, but we've been right about a few things. And I think healthcare is absolutely going to do well in the first half of this upcoming year. You look at the big cap pharma names, Pfizer, Merck, Eli Lilly have been doing fantastically well. UNH is up off the mat. Hospitals have been doing well. And you mentioned energy. I don't know if energy is going to finish next year well, but I tell you, for the first couple of months, I think it's going to do very well because I think you're going to see continued weakness in the dollar. And I think commodities are going to be an underappreciated asset. So for me, it's healthcare and energy.
And healthcare, because it was one of the underperformers this year, up about 19%, but well underperforming tech, which was the leader. Is that part of the reason?
It's part of the reason, but I also think, listen, pharma had an absolute bullseye on their back earlier this year for political reasons. That seems to have abated a bit, and I think the fundamentals will take over. And valuation-wise, a lot of these stocks make a lot of sense.
What do you got, Dan?
So it really depends how we start, I think, January. I think that's going to set the stage. I think there's a lot of technicians who would say a pullback to 3,000 in the S&P 500 would be something that would be very welcome if you're really thinking about what 2019 was like. We finally had that breakout of this consolidation above 3,000, and that would be kind of an area I think that a lot of investors would like to reload in. But to me, I think that if you're going to play a little bit of catch-up, the Russell 2000, the IWM, the ETF that tracks it, that broke out above 160. It's trading about 165. I think you could play a little catch-up in the small caps there. They've underperformed. They have not gotten back to their prior all-time highs. We know the S&P and the NASDAQ have made basically new ones every day for the last, feels like 2 months or so. So I think there's some catch-up trades that might work. That just depends if you think that we're just going to kind of take off from current levels. I think a pullback to 3,000, again, reiterating, would be something really healthy. And then you can start to focus on some of those reasons why the market went up over the last few months on that breakout.
Karen, what do you think? Catch-up trades or winners going to keep winning?
I think a little bit of both. I mean, for me, winners are going to keep winning. I'm going to hold them in my portfolio, the biggest positions, Google, Facebook. The banks have been on a very good run this year, but I think there's still room to run if the economy is fine. I think that some of the really, energy guys cited. I always like to look at a disaster that's really cheap. The space is somewhat of a disaster.
There you go. You got one there.
Retail, some of retail, disaster and really cheap. I mean, I don't own it, but if you think about a name like Bed Bath & Beyond is up huge from the bottom.
Yeah.
I don't know that it is in any way out of the woods from the Amazon effect and their own need to clean up their own business. I don't know, but that's interesting to me, those kind of things. And then, to me, the biggest question mark is who ends up being president, because I think so many more things will change off of that than any other thing. The one other thing that I do think has started to work and will continue to work is outside of the U.S., that will do better relative to the U.S. because the U.S. has outperformed for so long now.
It's so interesting in retail because obviously some names have done so well and some of them have done so poorly. When you look at the S&P 500, the biggest underperformers of the year, you got a lot of retail names in there. Yeah. Gap is a big one, down about 40 or 30%. L Brand's down 30%. Macy's shed more than 42% of its value in the year. I don't know if it goes up. The dividend is still pretty nice there on some of those.
The dividend's nice, and they're buying back debt.
They are.
So that's interesting.
Well, what do you think?
But when you look at retail and you look at energy, it seems like those are trades to me versus long-term investments. So when I look at the market, what has outperformed 10 years, 5 years, 3 years, year to date? Tech. Stay there. Why make this complicated? Go to the semis, go to tech, stay underneath any subsector. If the market comes in, they'll all come in too, but longer term, tech.
Because you don't think the market can go up without tech continuing to win?
No, there's no way. With market cap, when you're market cap weighted, there's no way. It's such a big piece of the S&P. You need to be there. That's where the growth is. That's where you have to stay long term.
What about when you're looking at broader markets? Are we going to hit 3,000 before we hit 3,500 on the S&P?
I agree with Dan. I'd like to see a pullback. I think you could see a pullback in the first quarter because everything was so lopsided. People were chasing. But it is a buyable dip, and I would still continue to invest in them.
Yeah, I feel like the higher we go up in January, if we do continue to go up, it's the harder we're going to fall at some point in 2020. And then that's just kind of just physics, I guess. You know, if you think about it, I mean, I go back and look at 2018 and the weeks after the tax cut was put through in late December 2017, we had this ramp in the S&P 500. I mean, you couldn't find anyone to sell a stock. The S&P was up 8.5%. We get into Q4 earnings period, and they were fine. They just weren't as good as the stock market up 8.5% in January. And what did we do? We sold off, I think, double digits, 10, 11%. And it took us about 9 or 10 months to get back to that prior high. I think it was September of 2018, and then what happened after that? We saw a 20% peak.
And think about where all those estimates were. Everyone was calling for an earnings recession. Didn't happen. So wherever the estimates are on earnings is going to gauge how far and how fast we fall if the companies can leap over or step over those estimates.
That being said, earnings growth was not that amazing in the last several quarters here, and we still had this amazing run in the market here, especially in the fourth quarter.
But bonds moved a lot, right?
True.
So we had the 10-year go from north of, I don't know, beginning of the fourth quarter last year, 3.25 maybe, down to 145 at the lowest. So, you know, the multiple that you use to price equities, that changed, even if the earnings stream didn't. I don't know what happens if that starts to move the other way, right? Then you could see multiples come in.
And I think that's a concern, though, Courtney. I mean, the volatility in the bond market is historic. Again, I mention this once in a while, but if the volatility in the bond market, in the equity market, was half that, we'd talk about it every single day, 24/7. I mean, to Karen's point, 10-year yield 3.25 this time last year, down to 145, back to 190, 150, 190 now. I mean, you're talking about historic moves in something that shouldn't move that way. That concerns me. But to Steve's point about trades, I agree. Your beat, the retail beat, which you do a fantastic job with, those retail are trades. Macy's here is a trade. Nordstrom continues to be a trade. Whereas a name like Walmart, I think, you know, valuation-wise, doesn't make a lot of sense. And Steve mentioned tech quickly. You know, Microsoft now at almost 27 times forward earnings. Texas Instruments, which has 0 EPS growth at 26 times. At a certain point, the question has to be answered. Do these stocks make sense on a valuation basis? I say no.
But what about when you say about rates? We're still the highest rate market in the world. So we still have inflation non-existent here. We have wages that are outpacing inflation. So what happens if the Fed cuts again? I'm not saying that they should cut, but the market still continues higher if they do cut, and no one is thinking about them cutting.
And we haven't really talked about how much the Fed has helped juice up this market in the last
100%.
several years. I mean, that's a really important part of this run.
In the last several months, I mean, the Fed has expanded their balance sheet by $400 billion, since the summer. They've also cut interest rates 3 consecutive times since July 31st at their meetings. When you think about this, 10 years after they went to 0 interest rates, the fact that they basically went from QT, normalizing rates in the end of 2018, to now QE again and cutting rates. That's kind of nuts, especially when you consider the fact that consensus estimates coming into 2019 for S&P earnings were about $174. You know where they ended up right now? Probably about $163. So you think about a stock market that's up 28% on the year. You've seen massive multiple expansion. I think the S&P started, somewhere in the low teens, and now we're pushing 20. Historically, that's expensive. If we don't get any confirmation that earnings are going to expand meaningfully, I think S&P earnings are expected to grow 5% in 2020 right now.
Is it enough that the Fed stance? It's a good point, because last December, it was a 180 from where they are now. And is that enough to compensate for lack of earnings growth? Where does that multiple expansion stop? The market right now is telling you that it still has room to go.
What is a big component of earnings? It's also margins. When you think about some of the things that you just mentioned about wage inflation, if you think about some of the stuff that's going on here, this is going to hurt corporate profits in 2020, especially if we don't have any meaningful movement on tariffs. You think about this phase one deal. We haven't even talked about this yet. It's really not that impactful. They rolled back some tariffs that were just put in place a few months ago.
But that was a major as a major headwind. Without that, you get a lot of closure and a lot more.
But sooner or later, Steve, a lot of these tariffs have been absorbed, over the last year and a half or so.
But don't forget,
later, they're going to be
35% corporate tax rate now, 21%. That's a gift that keeps giving every year.
Well, it is, except for the fact that the tariffs have actually counteracted a lot of the benefits that a lot of corporations.
And now they're going away.
And we don't even have a deal signed yet.
They're not going away. Well, there's no deal. That's the point. I mean,
it's a phase one.
Okay.
We'll see. It's not signed yet, but Trump says he's going to be signing it at the White House and then working on phase two. We'll see. Tell me when that ink is dry.